Hello there, this is fairbinaryoptions.com. I think that the title of this analysis is quite suggestive, as I am favoring put options on the euro and the Japanese yen. The thing is that this market is all over the place lately, in the sense that we had all these spikes up and down going for stops, hunting stops. For example, this was a moment of time, this were this high here and this high here, only for the market to hunt the stop, then a clear five-way structure to the downside, and then an aggressive move to the upside to break the previous highs. Where would you put your stop loss, for example? If you are trading the regular spot market, where would you put a stop loss after a five-way sequence like it is this one here to the downside? I'm telling you where. Here. Well, market is now here above that level, but I would really like to short the pair or to buy put options on the pair, as this level here is quite a nice area to do that. The reason for it is both from a correlation point of view, with the euro US dollar looking bearish as well, and from a technical point of view, I suspect that what we have here is actually nothing but a contracting triangle that just ended, and this contracting triangle is bearish in my book. It all starts with a move low, or with this move low, which is channeling extremely well. It is extremely aggressive, but because it is channeling that well and it is that aggressive, it means it is a corrective wave. Usually such corrective waves are being X waves, or intervening X waves, or connecting X waves, waves that make the connection between multiple corrective waves. So if this is an X wave, then I suspect that the end of wave A to the upside of a triangle of the same degree would be here. Then we'll have a B wave to the downside, all the way to the downside here. One question will be, why the B wave here and not here? Because the future B2D trend line to develop is not supposed to be broken by any parts of the upcoming C wave or the upcoming E wave. So this is the clear, let's say, rule for our B wave. Then we have the C wave to the upside, and you might say, alright, why the C wave to be done here and not here? Because the move here is impulsive, and the leg of a contracting triangle needs to be always, or to come always, in a corrective fashion. And I'm talking about here, of course, of a three-way structure. Well, the three-way structure is this one, A, B, and C. For the C wave here of a lower degree is definitely an impulsive move. Then the D wave, and all this move to the upside is yet another move that is channeling too well. Remember what we've discussed here. Channeling too well, it means it is a corrective wave and not an impulsive move. So therefore, this should be our E wave out of this degree, that up here. Now, like any contracting triangle, this one travels as well within the A and C and B and D trend line, and our A and C trend lines is this one here. It can be broken, it's no problem if it is broken. Let's make it like this. And of course, the B2D trend line is the line here. And make no mistake, the path of this resistance or price should try now to break the B2D trend line and not moving to the upside anymore. So what I would like to do here is to buy put options, and this being Thursday, I would choose, of course, end of week expiration day for Friday. Now, I don't think that the market is going to go and break 136 to the downside, so 200 and something pips to the downside, before an important event like the Federal Open Market Committee next week. But the positioning should be to the downside, and it should be enough for our option to expire in the money. So, buying put options with end of week expiration date for the euro and the Japanese yen, as again this is as bearish as it can get in my book. Have a great day. fairbinaryoptions.com. Make sure you go on the website and check our analysis there. Make sure you check our recommendations and the Binary Options Academy projects. We have there a lot of educational series and a lot of things to learn. Thank you and bye bye.